With economic indicators and market signals sending mixed messages, the question on everyone's mind is, are we headed into a recession? Join us this week as we break down 3 crucial steps that retirees can take to safeguard their portfolios during these uncertain times.
Welcome to Leibel on Fire with Leibel Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Leibel on Fire.
With recession fears looming, liquidity becomes a safety net. How can retirees boost their emergency funds? And to answer some of these questions with us is Mr. Leibel Sternbach. He is the best-selling author of Living with Financial Anxiety, and there's some level of that right now. Would you agree, Leibel?
We haven't seen this level of anxiety probably since the beginning of COVID. Everyone got anxious, and then everyone was like, oh, this is fun, day trading from home. Now we're back to people are worried again, and they're really worried because there is just so much uncertainty of what the future holds. Nobody knows what tomorrow is going to bring.
So with recession looming, the fear of recession, I should say, looming, liquidity becomes a safety net. You've told us that before. What can retirees do, the people who are listening to your podcast today, boost their emergency funds and ensure that there is enough cash on hand to weather a potential turndown?
Yeah, so absolutely. The biggest threat that we have, and whether it is a market pullback, right, and it's just, the market goes down 10, 20%, 30% for an extended period of time, whether it's just a market pullback or we're talking about an economic pullback where businesses stop spending money, they stop hiring people, which we've already seen. The Fed wanted that to happen. They're trying to dial it in so that, it isn't a full pullback, but it just gets to a healthy level and stays there. So whether we have an economic one or a market one, the biggest threat that retirees have is that we still need to spend money. We're not getting a paycheck anymore, and we need to pay those bills, right? And we not only do we need to pay those bills, but we need to pay those bills at a higher rate than we did before because of inflation and because the cost of living has gone up, right? So as retirees, the thing that I teach every one of our clients, and if you're on any of my webinars, you've heard this a million times, is the biggest thing that you can do is build layers of protection into your plan. So whether the market goes up or goes down, whether we are in a recession or not, you have enough layers of protection so that you are protected. And the biggest way that you can do that is what I call time diversification, right? So you've heard the adage, right? Don't keep all your eggs in one basket. People kind of seem to think that just goes as far as diversification. Okay, so I shouldn't have all my money in one stock, right? Okay, good. Now they go, okay, I shouldn't have all my money in just the S&P 500. Good, that's a step in the right direction. But what you also want to do is you want to make sure that you diversify your money across time, and so that you have investments that are designed to provide you income for the next year or 2, 3 years, right? And then what happens after that? How are you going to live? How are you going to replenish that spending money? And so you have these different time horizons where you have, and what I like to do is a 3-bucket approach, where you have the money that you're going to use right now over the next few years, the money that's going to replenish that, and then your long-term money. And by diversifying it across time, now you can diversify it across risk. And so your short-term money, last few years, high yield savings has worked really well. Interest rates are coming down, right? We need to start finding greater returns, right, that are better than inflation, that will allow us to sustain that 4 or 5% withdrawal rate that we need in order to pay for our expenses. We recently launched an ETF called Yields for You Fund Strategy A. You can go Google it, which is us managing that, how we would for that low risk, right? Think of it like a high yield savings alternative. And then you've got your mid bucket, right? Your mid bucket is, okay, what's going to happen in 3 years, right? If I built up insulation for myself so that no matter what Trump does, no matter what the economy does, no matter what the market does, right? I can wait it out, right? I've got 2-3 years to wait it out. What happens if it takes longer? Because the last time, right, in 2008, it took 2.5 years to recover. We go back to 2000. It took almost 10 years to recover, right? And when you just look at the deepest plunges, right, that took 3 to 4 years. So you need something that's more than 2 or 3 years, right? But you still need some growth on there. So you dial up the risk a little bit, but it's still part of your shield. It's still part of what's protecting you so that you can have those long-term investments and be invested directly in the market. And whether you do something that has risk management or not, right, that's up to you. And that really varies from person to person based on how much money they have, how much they're spending, right? And we've got tools on our website to help you figure it out. But that long-term bucket can help you with the growth, right? What if this Trump economy and all these things that Trump is doing that people are worried about, what if it turns out aces up and it really is the best thing for us and our economy? You want to participate in that. You don't want to be sitting on the sidelines and going, well, I thought the economy was going to tank, right? Well, maybe you were wrong, right? And so you need to protect against that. But at the same time, protect against the possibility that you are right? And this is the easiest way to do it, is diversify across time. Do those 3 different buckets: money market / alternative in that first bucket, mid-risk in that second bucket, long-term growth in that third bucket. And that just by doing that, you put yourself head and shoulders above everyone else who's kind of riding the roller coaster. And every time the market dips, they're wondering if they should take their money out.
We're talking with Leibel Sternbach, and we're talking about strengthening your position with asset allocation now. So can you talk about, Leibel, some of the best practices that we can look at in rebalancing our portfolios to further reduce the exposure to high-risk access without sacrificing long-term growth?
Yeah, so in addition to what we just described of having these different buckets, what those different buckets allow you to do is to harvest during times of growth. You harvest that growth, right? So if Trump has a great month, right, and the stock market has a great month, harvest that growth, and now you're reducing your risk and you're putting it more into that lower risk bucket. And you're reducing, well, what if the market now goes down 20% from that point? You're reducing that. That is just simple rebalancing, right? Which is a very big part of active management, is saying, hey, what should we sell that's overbought? What should we buy that's undervalued, so that we're constantly maintaining the right risk level, right? Anyone could, hey, just buy and hold for the long haul, right? And sit on the edge of your seat and ride the roller coaster. That's easy, right? Everyone can do that. The problem is, how do you create the experience that you're okay with? So rebalancing during strategic times is very important. Doing tax loss harvesting during these times is very important. So as the market goes down, capitalize on those downturns, sell some of your assets, sell some of your gains, lock in those losses to offset future gains. During these years, those early years of retirement, ideally from when the time you separate from your job, but before you take Social Security and your income is really low, right? You get to control your income. You'll probably be in the 0% capital gains tax bracket, and you can do some tax gain harvesting, right? So harvest those gains at a 0% rate and use it to offset future income. So that is something that definitely you want to think about. And then you want to think about, how do I diversify my portfolio so that I'm not exposed to any one thing that'll happen in the market, right? Trump decides to put tariffs on steel with Mexico and Canada, and all of a sudden, right, you got a whole sector of the economy that is in danger. Well, you can protect yourself and look and say, how do I diversify myself so that if any sector or any combination of sectors get hit, that it doesn't upset my portfolio too much. And then there's always the option to just say, hey, I want to have hedged investments. I don't know what the future is going to hold. I don't need to get a home run. I don't need another 24% year. What I need is a consistent 8-10% a year in returns without the risk of really going down to 50%, right? Or having that absolute downside. And so you can now look at targeted outcome strategies where you give up the upside in exchange for participating in the upside to a certain extent, right? And that is something, that's what we do all day long for our clients, right? We've got the high yield savings side, we got the long-term growth, and then that middle bucket, that's the real work of a financial advisor, is to make sure that middle bucket that can't take on too much risk, but still needs to participate, is getting allocated as best as possible.
So, Leibel, what about the withdrawal strategy for retirees to preserve their capital? Are there some tax strategies that you can suggest for us today?
Yeah, absolutely. So the other thing that we do as financial advisors, and you got to ask your financial advisor if they can do this for you, because many compliance departments do not allow their advisors to do this. You would think that every financial advisor can do whatever they want, right? That it all falls under finance. It doesn't. right? So I happen to be an enrolled agent with the IRS. That gives me credentials for tax. I also started Yields for You because I was frustrated. I was at a corporate RIA where I was a partner. And I wasn't allowed to do things like tax planning. And I wasn't allowed to give the advice that a financial advisor really needed to give. And I had as much leeway as you could possibly get. But the firm wasn't comfortable with taking on that liability, and many firms are not, even though I have their credentials. And so I started Yields for You to be able to give that advice. So when it comes to taking that income, conventional wisdom says you should spend down your brokerage account first or your cash accounts first, and then you go to your retirement accounts and you leave your Roths for last. That is very poor advice. It is advice that honestly, I think is driven by the fact that for whatever reason, most financial advisors consider cash accounts or brokerage accounts to be money that they can't touch. And so they're like, yeah, go spend that money. That doesn't exist money because I don't get to charge a fee on that money, or if I'm charging a fee on it, it's very minimal and it's very difficult because there's tax consequences. So you go spend that money first, and then I'm going to work on this tax deferred money, and that's going to be what I charge my assets on. So we're going to spend that, the slowest. In reality, because nothing in life is ever simple, True. The real question you got to ask yourself is what is most beneficial for you? And the withdrawal strategy for every person is different. It is very different. For some people, we tell them to spend down the retirement accounts first because they're going to have huge RMDs down the road, right? And so we do spending down and Roth conversions to bring down those future RMDs because that's going to push them into the 39% tax bracket, right? And that's not something that they want or need because the IRS is going to require them to take distributions that are well in excess of what they need to live off of. For some people, we do the traditional of, hey, spend down your brokerage accounts first because we need to keep their taxable income down, and then we keep them in the 0% tax bracket. We harvest a whole bunch of gains because they have a whole bunch of banked gains from the last 20, 30 years of savings. But what I want you to think about, right, and as you approach this is you need to really have a plan. It needs to be based on your lifestyle. It needs to be based on what will get you the highest margin of safety in your plan, the highest probability of success. And that really needs to be what drives your decisions. For everyone, it is different and it depends on their goals. Some people, it isn't even about their personal tax efficiency. It's about the fact that they know that they're going to leave a spouse who's going to have this large sum of money when they pass and is going to be in the highest tax brackets possible. And so their goal is to bring down that widower tax. So you really got to look at it from a holistic standpoint and a personal standpoint. And we got tools on our website to help you with that.
Their website is yields4u.com, yields, the number 4, the letter u.com. We're just about out of time, but do you have information about protecting your portfolio there?
Yeah, we have information about protecting your portfolio. We'll create for you. We have a tool online for creating an ideal portfolio for you. We have information about how to bring down your RMDs, and it'll tell you, is it something that you should worry about or not? It helps with Social Security. We also offer a free retirement tax and SWOT analysis. So what we'll do is we'll take a look and we'll say, this is what we see as being your strengths, weaknesses, threats, and opportunities. And we'll tell you that if we were your financial advisors, this is what we would recommend. This is what would keep us up at night. And so you can kind of get that second opinion or that first opinion, right? If you like doing things yourself, perfectly fine, right? We do this for people all the time. And it's our pleasure. It's part of our mission to help 1 million people retire with financial security.
That's wonderful. And that's a wrap on today's episode on recession-proofing your portfolio. By strengthening your cash reserve, reassessing your asset mix, and fine-tuning your withdrawal strategies, as we've heard, you can build a buffer against economic downturns. Join us next week as we continue our conversation on proactive financial planning. I'm Freddie Bell, reminding you that a well-prepared portfolio is your best defense in uncertain times.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yields4u.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.